morning, sir.
Good morning. Good morning. Today we will discuss, as Sandeep have said, first we will discuss capital gain, how to calculate the capital gain and how to calculate indexation, how to calculate the capital gain tax. Then we will discuss what new has been done in last years as about capital gain, and then we will move further to other approaches of valuation, which is again very important for our day-to-day work, for our professional work. We will take some case studies which will make the things clear. So though, as Sandeep have already told you that this act has been changed in 2024, but still is scope for valuation as far as capital gain is concerned for our valuer professionals, and as well as it is important for those who are still to clear your IBBI examination. Many times you may get case studies based upon capital gain. So we will starting with certain case studies based upon capital gain. So main thing is when you do indexation, how you have to do indexation. There are two things involved in a building. One is building and other is land. So both may be calculated as jointly, or it may be in certain cases you may have to calculate the value separately in capital gain also. So one thing you must understand is how the indexation is to be done. So first thing is indexation of acquisition. So acquisition is the year in which you have acquired the property. So here you have to consider cost inflation index for the year of transfer. It will be in the numerator. Cost inflation index for the year of transfer or sale, you can say, multiplied by cost of acquisition and divided by the CII cost inflation index for the first year in which the asset was held by the assessee, or 2001 to whichever is later. See here. So this thing will be clear when we will be discussing our case studies. See here in the numerator, you have to take cost inflation index of the year in which the property has been transferred and multiplied by the cost of acquisition divided by cost inflation index for the first year. See here, first year in which the asset was held by the assessee, or 2001 to whichever is later. This is important thing, and these two things has to be calculated by the valuer depending upon the various clauses of the law, how to calculate the cost of acquisition and how to consider the year for this CII in the denominator part. These two things are very important. Similarly, when you have to calculate indexed cost of improvement, here you have to calculate in the numerator, it is again cost inflation index for the year in which the transfer or sale has been done, multiplied by the cost of improvement and divided by the KCII for the year in which the improvement to the asset took place. So these two things you have to take care of, and your duty is to find out cost of acquisition and this which year of CIA you have to use. Similarly, in case of index cost of improvement, you have to calculate cost of improvement And then the denominator part, CII for the year in which the improvement to the asset took place. So these four things as a CBDT valuer or income tax valuer you have to find out. So how it is to be done, we will discuss with certain case studies. This is first example. This is the simplest one. A residential flat admiring 90 meter square was purchased in the year 1995. See here, it was purchased before 2001 for rupees 13 lakh 50,000. It was sold on 1st May 2017 for rupees 65 lakh. As per the market inquiries conducted, it was seen that the fair market rate of the flat as of 1st April 2001 was 18,000 per square meter. Find the capital gain and tax applicable. Capital gain tax is 20%. This is given to you. See here, what is the data given to you? Cost of acquisition is given to you rupees 13 lakh 50,000. Then year of acquisition of the property it is given to you is as 1995, and year of transfer of the property it is 2017-18. And it is also given that cost inflation index for 2001-2 we consider it as base year, which is 100, and for 2017-18 it is 272. This is the data given to you. See here how you have to calculate cost of acquisition. This is important here. First, you calculate market value. As of 1st April 2001, it is given that per square meter rate is 18,000 per square meter, and 90 meter square is the flat area. So it comes out to be 90 meter square into 18,000, 16 lakh 20,000. This is a cost as on 2001 from the market point of view. But the cost of acquisition is in the 1995 it is 13 lakh 50,000. You have to take higher of the two. See here, you have to take higher of the two. Cost of acquisition or fair market value. You have to take higher of the two. So higher of the two is 16 lakh 20,000. So your cost of acquisition as of 1st April 2001 comes out to be 16 lakh 20,000. So how the indexation is to be done? See here, in the numerator it is 272. 272, why? Because it was transferred or sold in 2017-18 when the cost inflation index was 272 divided by the cost inflation index of the year. See here, this is in 1995 or 2001, whichever is later you have to take. See here, what is here? Cost inflation index for the first year in which the held asset was held by the assessee or the year 2001 to. So out of 1995 and 2001, it is 2001 which is later. So you have to take cost inflation index for the year 2001 to, which is 100. So it is 272 divided by 100 multiplied by index cost of acquisition, which is 16 lakh 20,000. So it comes out to be index cost of acquisition comes out to be 44 lakh 6,400. And sale consideration is given to you as 65 lakh. And capital gain you can calculate 65 lakh minus 44 lakh 6,400. It is 20 lakh 93,600. So this is taxable gain, or we can say it is capital gain. Over this 20 lakh 93,600, tax rate you know it is 20%. So 20% of 29 lakh 93,600 means a tax liability of 4,18,720. This is a tax liability of the person. So more two things you have to check in this case. See here, you have to take highest of the cost of acquisition and fair market value, that is 16 lakh 20,000. And second thing you have to consider this 272. Though the property was acquired in 1995, but as for this, you have to take whichever year is later, which is 2001. That is a point which you must consider. So I think all doubts might have been cleared by this example. So, but in this case, guideline rate was not given to you. If guideline rate is also available or it is also given to you in the question, then how to calculate the cost of acquisition, that is also important. Mr. X procured a commercial property in 1991 for rupees 92 lakh. He carried out improvements of rupees 50 lakh in the year 1998. In 2021, the property was sold for 10 crore rupees. The area of the premises is 1800 meter square. The guideline rate of the premises as on 1st April 2001 was 9,000 per square meter. Calculate the capital gain and capital gain tax. You have to calculate capital gain and capital gain tax. Since the period of holding is more than 2 years, see here, it will be calculated as long-term capital gain. So you must remember there are two types of capital gain. One is long term and other one is short term. So if the period is more than 2 year or 24 month, we will consider it as the long term capital gain. Now, so what is given to you? Cost of acquisition is given to you 19.2 lakh. Year of acquisition of the property, it is in 1991. Year of transfer of the property is 2021. Cost inflation index for 2001 is 100 and cost inflation index for 2021 is 300. 1. It is also given that the fair market rates of similar properties as determined through market investigation and analysis as on 1st April 2001 is 10,000 per square meter. Now, in this question, there are three things. One is cost of acquisition in 1991, which is 92 lakh. Second thing is guideline rate as on 1st April 2001, which is 9,000 per square meter. And third thing is fair market value of similar properties as determined through market and investigation as on 1st April 2001, which is 10,000 per square meter. Now, if all these three things are available, then how to calculate the cost of acquisition? This is a main difference between first and the second question. Otherwise, it is similar to the first question. See here, the fair market value of the property as on 1st April 2001. First, you calculate this, which is 18,000 per square meter is the area and the rate is 10,000 per square meter. It comes out to be 18,000 per square meter into 10,000, which is 1 crore 80 lakh. And second, guideline rate of the premises as of 1st April 2001, which is 9,000 per square meter. So from here it comes out to be 1 crore 62 lakh. So now, if guideline rate is available and fair market rate is available, then you have to take lower of the two. Then you have to take lower of the two. So lower of the two is 1 crore 62 lakh. So this we can say this is a fair market value as of 1st April 2001, which is 1 crore 62 lakh. And cost of acquisition and improvements. It is 92 lakh plus 50 lakh. He has done improvement over it, which is 1 crore 42 lakh. And now fair market value and cost of acquisition, you have to take higher of the two. You have to take higher of the two, which is 1 crore 62 lakh. This is an important thing. How to calculate the cost of acquisition. Once this thing is clear, then there is nothing in capital gain. Then then there is just indexation, nothing more than that. So this thing should be clear in your mind. First you calculate fair market value, then you calculate guideline rate, then consider fair market value as the highest of the two, and then you calculate cost of acquisition and improvement. So here improvement is done given as 50 lakh in 1998. So approximately we are not applying any depreciation over it, but if you want you can apply 3 years depreciation over it because it was constructed in 1998, but we have ignored that depreciation part. So once this is clear to you that cost of acquisition is 1 crore 62 lakh, then you do the indexation. Indexation, you know, cost here cost inflation index is 301 and divided by base year, which is 100, multiplied by cost of acquisition, which is 1 crore 62 lakh. It comes out to be 4 crore 87 lakh 62,000. And sale consideration is 10 lakh, but sorry, 10 crore. So capital gain is 10 crore minus 4 crore 87 lakh 62,000. It comes out to be 5 crore 12 lakh 38,000. So to calculate tax gain at the rate of 20%. Ji Manish ji, do you want to ask anything?
Yes, sir. Actually, just I was asking about the depreciation. Actually, the original property, commercial property bought at
Ji ji.
1990. So actually, 11 years depreciation shall be
So
considered, right?
sorry, not sir 11 years. It is we have to take it up to 2001
Yeah,
depreciation.
that's why 1991
It is,
property bought. So
it was improvement was done in of 52
still
lakh.
the actual
Uh,
original construction was in 1990. So from
you we have ignored
1990,
that part. We can take this. This is just
okay,
an example to make
okay,
you conversant how to calculate cost of acquisition actually.
okay, fine.
This is important thing.
सर ये इम्प्रूवमेंट में भी इंडेक्सेशन लगेगा ना?
जी जी लगा रहे हैं सर वो तो लगेगी बाद में। वो तो इसी में ऐड कर दिया ना हमने। वो बेसिकली आपको ये चीज बताने के लिए है ये क्वेश्चन। ये तो सेपरेटली आप कर सकते हो 98 का लेके फिर उसकी डेप्रिसिएशन करके उसमें ऐड करो, फिर 99 वाला अलग करो। ठीक है ना, वो डेप्रिसिएशन पार्ट वो हमने यहाँ पे कंसिडर नहीं किया, ये सिर्फ आपको ये चीज बताने के लिए सर, डेप्रिसिएशन वाला आगे आ जाएगा क्योंकि जी चेतने सर किसी की
Actually
आवाज
telling
आ रही
that, sir, actually telling that the fair market value or guideline value, whichever is lower, as per Income Tax Act, they tell that okay, stamp duty value or not more than the guideline value. Means stamp duty value means whatever the transaction happening in the market, that is the fair market value. That evidence get from the
सर।
concerned registered
इफ इन
officer.
केस कॉस्ट ऑफ एक्विजिशन इज मोर यू कैन टेक इफ इट इज हायर देन गाइडलाइन रेट।
No, so I'm asking that you're telling that if value or guideline value, whichever the lower, I have to adopt it, no? So my opinion is
मोस्ट
that
ऑफ
I
द
have to adopt
टाइम
the higher the value, no?
most of the time cost of acquisition is lower than guideline rate because after certain period of time guideline rate increases, but of course to be on the safer side if you take guideline rate nobody will ask you any question.
Yes, sir. If you
But
got
this
any certain evidence from the submitter, we can adopt that one and we can consider as a fair market value, no?
sir, I will give you after this case in the last we will discuss all these things. I will give you all the required things to you along with this presentation.
Okay.
Don't worry. So any other question? Next, Mr. A purchased a flat in the year 97-98 for rupees 22 lakh. He carried out improvement of rupees 3 lakh in the year 2000. In the year 2021, he sold the property for rupees 1 crore. The area of the premises is 150 square meter. The guideline rate of the premises as on 1st April 2001 was rupees 15,000 per square meter. Capital gain, calculate the capital gain and capital gain tax. See here, cost of acquisition is given to you as 22 lakh. Year of acquisition 97-98, year of transfer of property 2021. Cost inflation index of both the year is 100 and 301. The fair market value of the properties as determined through market investigation and analysis is 20,000 per square meter. Again, same procedure has to be applied. Fair market value of the property as on 1st April 2001, 150 square meter is the area, 20,000 per square meter. It is 30 lakh. Guideline rate is as 15,000 per square meter. Then you have to take a minimum of the two, lower of the two, which is 22 lakh 50,000. Cost of acquisition and improvement is 25 lakh. So you have to take higher of the two, which is 25 lakh. Again, you can do indexation. Indexation is 25 lakh multiplied by 301 upon 100, which is 75 lakh 25,000. Sale consideration is 1 crore. So capital gains is 24 lakh 75,000, and you can calculate the capital gain tax, which is as simple as in the first question. So here we are just considering this fact, how to calculate cost of acquisition, which is an important thing. Otherwise, the depreciation you can calculate, you know how to calculate. We will taking some examples where depreciation will also be considered. Mr. A purchased a flat in the year 97-98 for rupees 20 lakh. The flat was rented out in the year 2001 to for a yearly rent of 60,000. The area of the premises is 140 square meter. The guideline rate of the premises as of 1st April 2001 was 15,000 per square meter. In 2021, Mr. A sold the flat for rupees 95 lakh. Calculate the capital gain and the capital gain tax. Annualized yield was given in the year 2001 as 3%. This is given to you. So cost of acquisition is given to you 20 lakh. Year of acquisition 97-98. Year of transfer of property 2021. Cost inflation index for 2001 is 100. For 2021 it is 301, and taxes is also given to you in the year 2001 as 2000 per annum. So first we will calculate the value of the property here, because the property is given on rent. So we will calculate it from rental method or capital gain method we will be using. So 60,000 per annum is the rent given to you. Taxes is given to you as 2,000. You assume these things, which are not given to you. You may assume or not, it depends upon you. We assume that repairs at the rate of 4% of gross rent, which is 2,400 per year, and collection and management charges as 4% of gross rent, which is again 2,400. So net rent will be 60,000 minus these outgoings, which comes out to be 53,000 through. So you multiply it with the year's purchase, net rent multiplied by years purchase. So 53,000 through 200 multiplied by years purchase in perpetuity, which is 100 upon 3. So the value comes out to be 17,73,333. And guideline rate, which is 140 square meter is the area and 115,000 per square meter is the rate, which is 21 lakh. So you have to take lower of the two. Lower of the two is 17,73,333 and cost of acquisition is 20 lakh. You have to take higher of the two, which is 20 lakh. So if it is a rented property, you have to calculate its fair market value based upon rent capitalization. Otherwise, you calculate its indexation value 20 lakh multiplied by 301 upon 100, which comes out to be 60 lakh 20,000, and sale consideration is 95 lakh. So the capital gain 95 lakh minus 60 lakh 20,000, which is 34 lakh 80,000. And 20% is capital gain tax. You can calculate. The tax liability comes out to be 6 lakh 96,000. So the main thing here is to calculate the cost of acquisition, which is important. Otherwise, nothing new in it. Then we will be taking another example, which is important from capital gain purposes. In case of an industrial structure, if the company has been availing depreciation of its assets, then how to proceed in that case? The assessee company purchased a factory plot area 1000 square meter in 1990 at a cost of 5 lakh. Factory building of 800 square meter built up area was constructed on the plot in 1994 at a cost of rupees 22 lakh. The property was sold on 31st March 2021 for rupees 1 crore 70 lakh. Depreciation on building was claimed by the company from 1994 to 2020 and written down value in the books of accounts of the company was 10 lakh. Land rate in 2001 was 1000 per square meter. In 2021 was 5000 per square meter. Compute the capital gain for the limited company at 20% for long-term taxable capital gain. The assessee falls in the marginal tax bracket income tax 30%. Cost inflation index for 2021 is 301. The factory building does not form the block of assets. Guideline rate of the land in 2001 was 800 per square meter. This is a data given to you. So this is the important thing here. If the factory does not form the part of block of assets and the person has been availing depreciation and the depreciation written down value of the company, we have to take that value into account, which is 10 lakh. That is important thing. Then how to proceed in this case? So as per section 50A of IT Act, this factory building constitute a depreciable asset, in the working capital gain tax only written down value is admissible as a deduction. For the land part, you can take only this value, written down value, though the value may be much higher than that. Of course, for the land part, you can claim indexed benefit. This is as per section 50A of the Income Tax Act. So, as the transaction happened in 2021, the new provision of the explanation thereto inserted by Finance Act Section 55 with effect that fair market value of the such asset shall not exceed the stamp duty value wherever applicable of such asset as on 1st April 2001 is applicable. So land value in 2001 you calculate 100,000 square per square meter is a land rate, then 10 lakh land value, guideline value of the land 8 lakh. So you have to take lower of the two, which is 8 lakh, and index value 8 lakh into 301 upon 100, 24 lakh 8,000. So long term capital gain on land. Okay, the value, see here, you have to separate the land value and the building value. The property has been sold for rupees 1 crore 70 lakh. But land rate, so you have to separate the land value. Land rate is 5,000 per square meter and 1,000 square meter is the area. So the land value in 2021 comes out to be 50 lakh. 1,000 into 500. So what will be the building value? 1 crore 70 lakh minus 50 lakh. Building value is 1 crore 20 lakh. Okay? And long term capital gain on land comes out to be 25 lakh 92,000, 50 lakh minus 24 lakh 8,000, which is cost of acquisition. So for building, though the building value is 1 crore 20 lakh, but you cannot take it more than 10 lakh. So here it will be subjected to short-term capital gain because he has been availing depreciation up to the year 2021 and property has been sold in 2021. So there is a gap of only 1 year. It is less than 24 months. It will attract short-term capital gain. So land building part will attract short-term capital gain. So we have to calculate it separately. So here building component is 1 crore 20 lakh, but written down value is 1 crore 10 lakh. So, oh sorry, only 10 lakh. So taxable gain will be considered here as 1 crore 10 lakh. So on the land, because land will attract long-term capital gain, which is 20%. So 20% on 25 lakh 90,000, which is 5 lakh 18,400. And building part will attract short-term capital gain, which is 1 crore 10 lakh of 30%. Will attract a short-term capital gain of 30%, so which will be 33 lakh. So total tax liability will be 38 lakh 18,400. As far as value is concerned, your job ends here. You need not to calculate indexation. You need not to calculate capital gain. It is a duty of the chartered accountant or accounting persons, basically. So this is most important thing. Whenever you are doing the valuation of a company, you have to check whether they have been availing depreciation in their books of account and what is the value of written down value of the building in their books of account. That is most important thing. जी राघव जी
बिल्डिंग पार्ट दोबारा
जी
बिल्डिंग पार्ट दोबारा
see here sir, it is clear how we arrive, what is the value of the land. It is clear to you? See here, in 2021 building was sold, property was sold in 2021 and the value in 2021 was 5,000 per square meter. Area of the land is 1,000 square meters. So value of the land will be 1,000 into 5,000, 50 lakh. So the value of the land is 50 lakh, but the property has been sold for 1 crore 70 lakh. So what will be the value of the building? 1 crore 70 lakh minus value of the land. So the value of the building will be 1 crore 20 lakh. But in the books of accounts of the company, value of the building is only 10 lakh. Written down value of the building in the books of accounts of the company is given to you as 10 lakh. See here. You cannot take it more than 10 lakh. So what is the capital gain? 1 crore 20 lakh minus 10 lakh, which is 1 crore 10 lakh. So this 1 crore 10 lakh will attract, because he has been availing depreciation benefit up to the year 2020, and property is sold on 2021. There is a gap of only 1 year. It is less than 24 months. It will attract a short-term gain of 30%. So you have to apply 30% over the building part. Is it clear, Aghav ji? Just a minute. An assessee inherited property in 2001 along with his brother. They share 50% each. Plot area is 1200 square meter. Plinth area of the house is 400 square meter. House was constructed in 1991. In July 2015, the elder brother acquired the half share of the younger brother for 15 lakh. The property was sold by the elder brother in November 2018 for 60 lakh, and legal charges were 1 lakh 50,000. Compute the capital gain tax at 20% if the land rate in 2001 was 200 per square meter and building cost was rupees 5,000 per square meter. Cost inflation index for 2001 to 5, 6, 5, 15, 16 and 18, 19 are 100, 117, 250 and 280 respectively. This is given to you. See, many times you may get this type of assignment in your day-to-day work. We are just taking certain practical examples. So we will be discussing only basic part here. The cost of first thing is you have to calculate cost of acquisition. Cost of acquisition as on 1st April 2001, land is 1200 square meter and land rate is 200 per square meter. It comes out to be 2,50,000. Building replacement cost. Building replacement cost for 400 square meter is the area and 5,000 per square meter is the late. So 400 into 5,000, 20 lakh is the building cost, building replacement cost. So now we can apply depreciation. So it was constructed in 1990. We are calculating value in 2001. So we will be applying a depreciation for 10 years. So we will be applying straight line method. So assuming the life of the building as 70 years, 10% as salvage value. So depreciation will be 10 upon 70 into 90, 12.85%. So depreciation will comes out to be 20 lakh into 12.85%, which comes out to be 2,57,000. So depreciated value comes out to be 17,43,000. So this part is clear to you as a value. You know how to calculate depreciation with straight line method. There is nothing new in it. Now how to calculate indexed value or value? See here. In 2001, he has taken half portion. So 24 lakh, 2 lakh 40,000 into half. In 2001, it is 1 lakh 20,000. Again, building in 2001 was 17 lakh 43,000. So 50% of it he has taken, which is 50% of 70 lakh 43,000, 8 lakh 71,500. So this is the value for cost the elder brother in 2001, 9 lakh 91,500. See here, I think it is clear to you. And again, he purchased the remaining part, including land and building together, for 15 lakh in 2015. Clear? Is it clear to you? Okay. Now you can do indexation. It is normally done by chartered accountant on the original asset in 2001 and 280 in the year in which the property was sold, 9,91,500 into 280 upon 100, 27,26,200. Then cost of improvement, it is also 15 lakh into 280 upon 254. So this is 16 lakh 53,543. Sold in 2000 for 60 lakh. Brokerage charges are 1 lakh 58,000. So this is a net gain 58 lakh 50,000. And index costs are 27 lakh 76,200 plus 16 lakh 53,453. This is the index cost 44 lakh 29,743. So the taxable gain is 14 lakh 20,257. So over this you can apply 20%. But of course your work ends here. As a valuer, your duty is to do calculation up to this level. Other part is related to chartered accountant. Otherwise, as a professional, you must know these calculations. But you need not to give your client these calculations. A plot in central commercial area of Ludhiana was sold in February 2019 for rupees 6 crore. The area of the plot is 1200 square meter. It is an inherited plot. In the year 2001, the said plot was in settlement zone, a residential zone. Perusal of document registered with Office of Sub-Registrar at Ludhiana revealed that the rate of commercial zone in Ludhiana in the year 2001 was 5,000 per square meter and the rate of residential plots was 2,500 per square meter. Give your opinion about the rate or value of the plot as on 1st April 2001 for capital gain valuation. Also find its index cost of acquisition. So basically, when the plot was purchased, it was in residential zone. But when it has been sold, the property falls in a commercial zone. So the value has to, but because it was purchased in 2001 and that time it was a residential plot, and so we will calculate its value from residential point of view, not from commercial point of view. So, but what we can do, see here, residential rate is 2,500 per square meter, but as it has been converted into commercial zone, and of course, when it is will be converted, its FIR will be increased, say from 100 to 200%. So, what can you do? Looked at the registered document reveals that commercial zone plots was 2 times the rate of settlement zone plots. So an increase of 50% of difference can be reasonable for the potential of conversion to commercial zone. So 50% of increase 5,000 minus 22,500. we add a value of 1,250 to 2,500. So we consider the rate as 3,750 per square meter for calculation. Because it has been converted into commercial and all other properties in its vicinities have also been converted into commercial, though the purchaser has purchased it as a residential plot, what we can do, we can safely add our in this way as an experience value. You have to check how much you can do, maybe 50% or maybe less than that. So you assume the value, we assume that an increase of 50% because of potential for conversion to commercial zone. So the value we assume, instead of 2,500 per square meter, we assume it to be 3,750. So 1,200 square meter is the area and we assume the rate of 3,750. So value comes out to be 45 lakh, and indexation you can do 45 lakh into 280 upon 100, 1 crore 26 lakh. So many times you get such type of assignment. When the property was purchased, it was a residential property, but when it is sold, the property falls in a commercial zone. Then how to proceed in such cases? An inherited old house constructed about 80 years back, but still in a very well-maintained condition, situated in Krishna Nagar, New Delhi, was sold in January 2019. The area of the plot is 200,000 square meter and the area of the house is 400 square meter. If the property was sold for 3 crore 50 lakh. Rate of residential plots in Krishna Nagar in 2001 was 1,200 per square meter. Replacement cost of the house in 2001 can be taken as 5,000 per square meter. Find the indexed cost of acquisition. See here, now the building is 80 years old, but from the inspection we find that it is still in a very good maintained condition. So what we assume that? We assume that till it can live up to 35 years. We assume that from the inspection, we assume that future life of the building is taken as 35 years. And the total life we assume as 75 years, though the building is 80 years old. For calculation of depreciation, we assume the total life of the building as 75 years. This is just for calculation purposes, though the building is 80 years old. So what we can do, value of the land, you can calculate. This is the area of the land, this is a rate. So 2000 into 1200 per square meter. So the value comes out to be 24 lakh. And expected lifespan we assume at 75 years. Future life of the structure is on 35, on 1st April 2001 assume as 35 years. So we can calculate depreciation assuming 10% as salvage value, 40 upon 75 into 90, 48%, assuming a salvage value at the rate of 10%. So the depreciation rate is 5,000 minus 48% of 5,000. So depreciated rate per unit comes out to be 5,000 minus 2,400, 2,600 per square meter. 400 square meter is the building area. So 400 into 2,600, the value of the building part comes out to be 10 lakh 40,000. So the total value of the land, which is 24 lakh plus 10 lakh 40,000, which is the value of the building, 34 lakh 40,000. So you calculate its indexed value 34,40,000 multiplied by 280 upon 100, which is 96,32,000. So here we have applied straight line method of depreciation, but CBDT, they have allowed you to use sinking fund method of depreciation. So sinking fund method of depreciation, it will give you higher value than this 96,32,000. And thereby it will be reducing the tax liability of the client, your client. And you can use, because it is legally permissible, you can use sinking fund method. So we will check how it will make the difference. See here, second method, value of the land will remain same as it is in the first method we have calculated. Then 75 year is the total life and 35 year is the age we have assumed. So you know how to calculate sinking fund depreciation. You calculate sinking fund for 75 years. You know the method. So it is basically IC into R. So you can calculate this. Sorry, it is IC into S. As you know, it is future value minus 1 upon R. Here you have to take life of age of the building. Then IC you can calculate as R upon 1 minus 1 plus R raised to power n minus 1. So this two you know, you can calculate sinking fund, which is 0.000445, and amount of fund which is a cumulative sum, which is 199.63. So you multiply it, both of them. So see here, the depreciation only comes out to be 7.914%. So the depreciated value, 7% of 5,000 to subtract. So value per unit comes out to be 4,600 per square meter, and the value of the building comes out to be 18,40,000, and the total value comes out to be 42,40,000 value of the property, and indexation cost comes out to be 1,18,72,000. See here, with sinking fund if you apply sinking fund depreciation, the value comes out to be 1,18,72,000, and if you apply straight line method of depreciation, it comes out to be 96,32,000.
Sir, can you please explain this sinking fund concept? I'm not, some of us are not aware of this, please, sir.
Oh, sorry, sir, I will do one thing. We will take a case of sinking fund depreciation after this
Right.
capital gain is over.
Right, sir.
So I don't need, I do not want to stop the flow of the
Right, sir.
subject.
So it was a subject during your examination, sinking fund.
So,
We will discuss, no problem. We will discuss it after completing the session at the 0 hour.
we will discuss. Okay, sir. So in this way, you can save the tax liability of, reduce the tax liability of your client. Next, a flat admiring 100 square meter in a building constructed in 1980 was purchased in 1981 for rupees 1,50,000. It was sold by the owner in February 2021 for 42 lakh. Expenses incurred towards the sale in the year 2021 was 1,50,000. The owner had changed tiles, provided modular kitchen cabinet, new electrical sanitary fitting in 2015 at a cost of 4,50,000. Find the cost of acquisition and improvement and the capital gain tax liability. So here it is again given to you that the rate of new flats or similar specification in 2001 was 9,000 per square meter, and guideline rate was given to you as 8,000 per square meter, and cost inflation index in 2001 is 100, 2015 is 254, and 2021 it is 301. It is given to you. So it is simple as we have calculated. Only thing you need to calculate accurately is cost of acquisition. Otherwise, nothing new in it. Cost of acquisition in 1981 is 1,50,000, and value in the 2001 market rate of new flats is 9,000 per square meter, and guideline rate is 8,000 per square meter. Of course, you will be considering lower of the two. It is 8,000 per square meter. So the value 100 into 8,000, it comes out to be 8 lakh. The assessee will choose the higher of 1,50,000. This is and 8 lakh. So of course you have to take higher of the two. So 8 lakh is the cost of acquisition. So this is the main thing here. Otherwise, indexation, you know how to do indexation. You multiply it at lakh into 301 upon 100, and index cost of acquisition here instead of 100, you have to take the year in which the improvements were done. Improvements were done in the year 2015. So you have to apply cost index, inflation index for 2015, which is 254. Instead of 100, it is 254. So you calculate the total value A plus B. There is nothing new. Taxable gain you can calculate. This is a sale price and this is a cost of acquisition and other things you subtract. You calculate the taxable gain, which is 11,08,732. And from here you can calculate capital gain tax at the rate of 20%. So in next question, another thing is, in case of gift, how to calculate the cost of acquisition. This is another important aspect. An assessee received a gift of a flat having an area of 80 square meter from his uncle in May 2012. The flat was purchased by the uncle in June 2004 for rupees 1,85,000. The assessee approved the flat in September 2015 at a cost of 1,50,000. The flat was sold in February 2019 for 20 lakh. Society transfer charges and brokerage charges were 75,000. Capital gain tax is at 20%. Other cost inflation index for 2001 to is 100. June 2014 it is 113. May 2012 it is 200. September 2015 it is 254. And in February 2019 it is 280, which is given to you. So see here, only thing is important here is cost of acquisition. So if it is a gifted property, in that case, as per the provisions of Income Tax Act, in case of gift, cost of acquisition shall be cost to the donor. Remember. So this is the important thing here. Otherwise, there is nothing new in the question. Here, the cost of acquisition is important thing. So cost of acquisition in case of gift, it is the cost of honor, which you have to consider. And cost of honor, of course, he is in June 2004. It is 1,85,000. This is the important thing which you have to take into consideration. Otherwise, nothing new in it. So once cost of acquisition is known to you, otherwise in other things you have to apply only the indexation part. So cost of acquisition is 1,80,000. 1,85,000. You multiplied it with 280 upon this is 113 is the cost inflation index for 2005. You calculate the cost of acquisition. Index cost of acquisition comes out to be 4,58,400. 7. You apply improvements were done in September 2015. You calculate its indexation 1,50,000 multiplied by 280 divided by 254, which is cost inflation index for 2019, which comes out to be 1,65,354. Then index cost of acquisition, you add both of them. This is indexed cost of acquisition. And other expenses are given to you as 75,000. So taxable gain you can calculate. This is 13,01,239. And you calculate capital gain tax. Otherwise, your calculations work here. Up to up. Otherwise, if you want to calculate taxable gain, you can calculate. A settlement zone plat measuring 650,050 square meter was purchased in 1996 for a price of 5 lakh. Ground floor admiring 100 square meter was built in 1999 at a cost of 5 lakh. It was let out in 2000 for rupees 5,500 per month, and property taxes were 1,500 per 6 month. The first floor was built in 2011, 100 square meter area at a cost of 12 lakh 50,000. The guideline rate in the locality was 1,000 per square meter in 2001, and market rate was 1,200 per square meter. The guideline rate of built up area in the year 2001 was 10,000 per square meter. Property was original asset with vacant possession of ground floor as well as of first floor was sold in September 2020 for a total price of 80 lakh. Compute the capital gain tax at 20% and legal charges of rupees 1 lakh. Permissible coverage is 40% and permissible FAR is 100%. Cost inflation taxes for various years which is required for you is given to you. You have to calculate, compute capital gain tax. So now here is two things involved here. One, ground floor, which is given on rent, and the other part, first floor, which is owner occupied. So as far as owner occupied portion, it was built in 2011 for rupees 12 lakh 50,000. So you did not to do anything about it because it is in 2011, which is after 2001. So it will remain to 12 lakh 50,000, nothing to worry about it. The only thing is how to calculate the value of land in this case and how to calculate the value of ground floor in this case. That is the important thing. Clear? So now we will be concentrating on how to calculate the value of the ground floor and how to calculate the value of the land in this case. Please be attentive. See here, value of the property in 2001. Rental ground floor, 5,500 per month. So total length, 66,000 per.
Yeah, sir, excuse me. Friends, if you are having any doubt, either raise your hand. You will be asked to raise your question. Otherwise, please note it down, and at the end of this particular topic, you will be given sufficient time to ask any doubt. We will not continue until and unless each and every doubt will be cleared. However, if you during particular calculation, if you are having any doubt, please raise your hand, and as soon as possible, we will call you to ask your question. Yes, sir. Please continue. Sorry to interrupt.
Sorry. Okay. Thank you, Sanjeev. So you calculate rent. Rent per annum comes out to be 66 lakh. Taxes is given 1,500 per 6 months, 3,000. We assume these repairs at 4% of gross rent and for management and collection charges at 4% of gross rent, 2,640 each. So the net rent comes out to be 57,720. We assume 8% ARY, annual rent yield. So YP will be 100 upon 8. So market value or capitalization value 57,000 to 720 into 100 upon 8, 7,21,500. And guideline rate for the ground floor, it is given to you as 10,000 per square meter. So which is 10 lakh. You have to take lower of the two. See here, you have to take lower of the two. So which is 7,21,500. So this is a value which is considered. So now we will consider, this is the value of the building part which is to be considered. Now what will be the value of the land part? So you know what is given to you here. Permissible coverage is 40%. So land part, which will be the above value is arrived fair market value of the ground floor and the land part attached to it. The land apperent to the ground floor 100 square meter at 40% coverage will be 250 square meter. So balance land is, so this value 7,21,500, this is the value of the ground floor which is given on rent, including land and building part. This is the value of land and building part of the ground floor. So what will be the remaining part which is not considered here? So 40% is given to you as plot coverage. So 250 square meter will be the land which is including in this 7,21,500. Remaining 60% of the land are 650 minus 2 for 40, 400 square meter land will be considered. So value of the 400 square meter land, 1,200 per square meter, which is guideline rate 4,80,000, and the guideline rate is 1,000 per square meter, which comes out to be 4 lakh. So you have to take minimum of the two, so which is 4 lakh. So this is a value of ground floor, which including land and building part of the ground floor. This is the balance value of the land, and then of course 12,50,000, which is the value of your first floor. So value of ground floor plus building part attached to it plus 4 lakh value of the remaining land portion. It comes out to be 11,21,500 plus 12,50,000, which is the value of the first floor as it is. So the total value comes out to be, add both of them, you calculate index value 11,21,500. You calculate its value, indexation value. Here the indexation value is to be calculated on the basis of year 2001. This was done in 2011. So here the indexation is to be done as per 2011. You will apply indexation separately to both of these and calculate the total index cost, which comes out to be 54,20,550. So you calculate net gain. One crore is the sale price minus 5 lakh. You add both of them. So well, taxable gain comes out to 24/7. You can calculate. So this is how, if the certain portion is given on rent and the other portion is owner occupied, and how to proceed in such cases. Then in case of demolition, if you demolish certain part and reconstruct, then how to proceed in such cases? Many times you may be having such type of assignment where the building was demolished and again it was rebuilt. A plot 500 square meter was purchased by Mr. X in 1981 for 1 lakh. X built a house in the said plot having an area of 200 square meter in the year 1992. The cost of construction was 5 lakh. Mr. X demolished the house in 2005 and constructed a new single-story residential house admiring 250 square meter. The cost of demolition was 50,000 and the cost of construction of new building was 17 lakhs for 50,000. Mr. X subsequently added first floor to the said house admiring 100 square meter in the year 2010. The cost of construction of first floor was 10 lakh. Mr. X sold the property on 25th January 2019 for a consideration of 1 lakh 1 crore 50 lakh. Find out the capital gains tax to be paid by Mr. X. The rate of residential plots in the area in the year 2001 was 2000 per square meter. Cost of construction of similar structures in the year 2001 was 7,000 per 500 per square meter. Cost and inflation indexes are given to you for different years. And see here, what is given to you? Area of the plot 500 square meter. Area of the old demolished house 200 square meter. Rate of the plot in the year 2001 2000 per square meter. Rate of the construction in 2001 7,500 per square meter. See here, first you calculate what was in 2001. First thing is value of the land. Fair market value of the property you have to calculate as on for 2001. Value of the land 500 square meter into 2000 square meter, 10 lakh. Okay, and depreciated cost, area of the house 200 square meter, replacement cost 7,500. Age of the structure is in the year 2001 is 9 years. And expected life, assume expected life as 70% and salvage value as 10%. Depreciation is 11.57%. So depreciation amount will be 7,500 into 11.57%, 867.75 per square meter. So depreciated rate of construction will be approximately 6,600 per square meter. So depreciated replacement cost 200 square meter into 6,600, it is 13 lakh 20,000. So the total depreciated fair market value 13 lakh 20,000 plus 10 lakh, which is 23 lakh 20,000. So see now here how the indexation is applied. So the above value is adopted as the cost of acquisition and improvement, which is present in the present case is 6 lakh, which is given to you. So we will take higher of the two. So cost of improvement, again in 2001 it was constructed. Cost of demolition was 50,000 and the cost of new construction was 17 lakh 50,000. So cost of improvement in 2004 is 18 lakh. Then again in 2010 certain improvements were done. That cost of US 10 lakh. So now how to apply the indexation? 2001 cost of acquisition or improvement is 23 lakh 20,000. Your multiplier factor will be 280 upon 100. So 64 lakh 96,000. In 2004 again reconstruction was done after demolition where the cost was 18 lakh. So the multiplier factor will be 113, which is the cost inflation index for C year 2004. The value comes out to be 44 lakh 60,177 and 2001 value is 10 lakh. Multiplier factor 280 upon 167, which is a CII for 2010. The value is 16 lakh 76,640. So total value 1 crore 26 lakh 32,824 and capital gain will be 1 crore 50 lakh minus 1 crore 26 lakh 32,824. This is the capital gain or taxable gain 23 lakh 67,176. You take its tax at the rate of 20%, which is 4,73,435. See, in this question, see, there are two things involved. Mr. Raman purchased a plot in Bangalore for rupees 20 lakh on 1st 5th 5/7/2010. He constructed a residential house on the plot which was completed on 28th December 2017. The cost of construction was 45 lakh. The property was sold on 16 August 2019 for 95 lakh. The sale deeds does not mention the value of the house and plot separately to compute the capital gain. Now see here, plot was purchased in the year 2010. Building was completed in the year 2000. Sorry, it was completed in the year 2017. Property was sold on August 2019. Now, see here how to proceed in this case. So, land part will be subjected to long-term capital gain because purchased in 2010 and sold in 2019, which is more than 24 months. But the building was constructed on 12/2017 and the property was sold on August 2019. So building part will attract short-term capital gain as it is less than 24 months. This is the important thing. As a valuer, you have to consider this fact. And of course, you are given only total value which is 45 lakh and now you need to calculate the value of the building and the plot separately so that you are able to calculate the capital gain tax separately. That is the important thing. So cost of the construction is arrived at say 50 lakh for land component. So let us suppose you calculate somehow the value of the construction as 50 lakh as on the. So the value total is 95 lakh, out of which we assume that 50 lakh is the value of the building. You may here data is given not given to you. In your case, when you are doing valuation, you will be having all the data about the plinth area rate and plinth area of the building. You can calculate this value easily as on 2019. Taken otherwise also, the cost of construction is given to you as a 45 lakh in 2017. We assume it to be 50 lakh in the year 2019. So cost of construction is 50 lakh. Total cost, it was sold for 95 lakh. So the value comes out to be, we assume that the land component is 45 lakh. So 45 lakh will be full value of consideration is 45 lakh. Otherwise, cost of land 20,000, which is a purchase price 20 lakh in 2001. So you calculate the indexed value in 20 lakh into 290, 29 upon 160, 34 lakh 61,878. So On long-term capital gain, this will be the 10,38,922. Okay, out of 45 lakh, this is the index value. So the taxable gain is 10,38,922 for the land part. Or the land part you can calculate. For the building part, it will be subjected to short-term capital gain, which you can calculate, which will be at the rate of 30%. So this is a full value consideration for is 50 lakh and 45 lakh, which is you have actually spent. So short-term capital gain will be 5 lakh. So in such cases, you have to proceed in this way. Mr. R owns a plot plus house property which was purchased by him on 1st May 1989 for 15 lakh. The area of the plot is 500 square meter and the house is 300 square meter. The said house was fully destroyed by fire on 25th May 2018 and R received a sum of 60 lakh from the insurance company during the year. Age of the structure in 2001 was 15 years and the replacement rate is 7,000 per square meter. Compute the capital gain. So here, see here, he has received a sum of rupees 60 lakh from the insurance company. He has to pay capital gain over it. So area of the house is 300 square meter. Replacement rate is 7,000 per square meter. Age is 15 year. Expected, we assume factored lifespan as 60 years. You calculate depreciation assuming 10% as salvage value, which comes out to be 22.5%. So the rate instead of 7,000, depreciated rate per square meter is 5,425 per square meter. So depreciated replacement value comes out to be 16,27,500 multiplied by 280 upon 100. For indexation, the value comes out to be 45,57,000. So long-term capital gain is 14,43,000. You calculate at the rate of 20%, which is 2,88,600. And of course, in the case of insurance, you have to take only superstructure part, not the foundation and land part is not taken into consideration. Only superstructure part of the building is taken. We may subtract 10% of foundation part also if you consider fit. Now another important thing, that rural agricultural lands are not subjected to capital gain. Only urban agricultural land are subjected to capital gain. This is as per section 214 of the Act, which defines agricultural property constitute a capital asset and by corollary which does not. From its definition, it is clear agricultural property which is rural in nature does not constitute a capital asset. Hence, gains which arise from the sale of such rural agricultural properties are outside the ambit of capital gain tax. It is also clear that agricultural property which is urban in nature constitute capital asset. So remember, if a property is urban agricultural, it will attract capital gain. But if it is a rural agricultural property, it will not attract capital gain. So this Act 214(3), it summarized agricultural land is classified as urban agricultural land in the following circumstances. if it is within the jurisdiction of municipality or a cantonment board having a population of 10,000 or more, it will be considered as an urban agricultural land. And if it is situated in an area within the aerial distance of 2 kilometers from the local limits of any municipality or cantonment board with a population of more than 10,000 but not exceeding 1 lakh. And if it is situated in any area with the aerial distance of 6 kilometers from the local limits of the municipality or cantonment board with a population of more than 1 lakh but not exceeding 10 lakh. And if it is situated in an area within an aerial distance of 8 kilometers from the local limits of municipality or cantonment board with a population of more than 10 lakh. जी मनीष जी. So here the population means population according to the last preceding census, which the relevant figures have been published before the first day of previous year. So you can link ID website to know if a property is agricultural property or otherwise. You can visit this website incometaxindia.gov.in, pages utility capital assets 2014.aspx. So as a valuer, you can give an certificate to certify whether the property is an agricultural or urban agricultural or rural agricultural. For example, we take a property bearing survey number 10-1 of the part. This is the village name Diwali of part larger immovable property known as. This is the data given to you. So as per what you can do, you can take the aerial distance from the Google map from the what is the aerial distance, and then accordingly you can give your certificate that this property is at a distance of 12.60 kilometer and its population is so much. So this area is rural agricultural land instead of urban agricultural land. Ji Prati.
I have a question that if a property is located in rural, purchased during a time that was agricultural, then the classification was changed, then how would this valuation be done?
So we have taken an example, sir, that in that case you can assume you have to calculate the value according to agricultural, but you can increase the rate somewhat by certain percentage depending upon the conditions and your experience, that how much reasonable rate you can increase. You cannot take the value of residential property. You can take any value in between agricultural rate and residential rate in between them, which you can defend. If you are able to defend, if you are not able to defend, then take its rate as agricultural.
And you have to mention the justification in your report that why you are adopting that particular rate and why not the lower rate.
Okay.
Ji Manish ji.
Yes,
Sir, your voice is not audible.
now it is audible.
Ji, sir.
My question is, if the land is adequately away from the municipality zone, means it is in the as per distance criteria, it is in the rural agriculture zone, but the land falls in the afforestation zone land. in that case, would that be considered as a rural agriculture land?
So it will depend upon the condition. If it is
The
an agricultural land and agricultural is,
afforestation, actually,
if it is a,
afforestation zone means is in the just like a forest zone. Means there
so
are the
you, so in forest zone, only thing is you can do agricultural part. You cannot do transfer of property. You cannot sell that property.
It is a reserve
okay.
land and you cannot sell and purchase in the forests.
Only thing
It is
is,
a
if
land
they
for
have allowed
reserved
to,
for
you
forest.
can use it for agricultural purpose. If the forest authorities have allowed you, otherwise you cannot
Okay.
take this. So capital gain will be only applicable if the sale transaction take place. If you cannot
Okay.
sell that property, Ji Abhishek ji.
That land, forest land is reserved for forest purpose only. If forest authority allow you to do some agriculture production on that, but that is not a ownership land. That is the ownership will be with the forest department, and you cannot be allowed to take the capital gain out of that because you are not the owner of that property. Yes, sir, Mr. Abhishek.
Sir, I purchased a property in rural zone in 1995, but I sell the property in 2021, but it's come under municipal limit. So how we calculate the capital gain?
So it will be considered as a urban property.
Okay,
It will be considered.
it will be
Because
considered as a urban zone.
it comes under the jurisdiction, whether it is after or before does not matter. Once
Okay.
it is an agriculture urban property, it means it is a urban property. When you have sold, at that time it is an urban property, then it will be considered as an urban property. What you have done at the time of purchase does not matter.
The classification will be on the date of valuation you are doing the report.
Okay, now there are certain changes in the capital gain in 2024 budget. First thing, they have removed the indexation benefit,
But this is
and
the
they
important thing. You should know what are the changes done by the central government in the recent budget announced by the Honorable Finance Minister, and it should be noted by each and every valuer before signing any report after a particular date which is announced in that budget. Yes, sir. Please continue. Sorry to interrupt.
sorry. First thing is removal of indexation benefit. The indexation benefit for long-term capital gains on real estate has been removed, and the property acquired after July 23rd, 24. The long-term capital gain tax has been reduced from 20% to 12.5%. And this indexation benefit has been withdrawn. Second thing is holding period. The holding period for real estate to qualify for long-term capital gain asset has been reduced from 36 to 24 months, which was already there. Of course, long-term capital gain. Then exemption threshold. The exemption threshold for long-term capital gain has been increased from 1 lakh to 1.25 lakh. So if you get a taxable gain of, if you get a capital gain of up to 1.25 lakh, you will not be subjected to any tax liability. This has been given, which was earlier it was 1 lakh. So these are the important things, dates you have to remember. Property purchased before 23rd July 2024 and sold before 23rd July 2024. 20% tax with indexation benefit. And property purchased before 23rd July 2024 but sold on or after 23rd July 2024. It will be 20% tax with indexation benefit or 12.5% tax without indexation, which results in lower tax. This is only for individual and Hindu undivided family residents in India. And the property is purchased on or after 23rd July 2024 and sold after 23rd of July 2024, 12.5% tax within taxation. No benefit of indexation for these properties. And of course, for non-resident Indian or for a company or firm, long taxable gain is 12.5% without indexation benefit. This benefit is only for individual and Hindu undivided families. It will lower of the two.
Any question or doubt related to this slide?
So you have to
Yeah,
remember
man.
this.
We will not continue until and unless each and every doubt is cleared. No doubt?
So we will be taking an example that will make the thing clear. The area of the house proposed to be sold is 11,600 square feet and the sale price is 11.58 crore to be shared equally between my elder brother, sister and myself. The fair market value is 5,100 per square meter and the present circle rate April 2024 is 28,500 per square meter. The indexation is 100 and 2024 363. Calculate the capital gain tax. So simply you calculate the fair market value 5,100 per square meter, or it is this is in square feet. You have to convert this rate into square feet also. So 5,100 per square meter, so rate comes out to be 473.75 per square feet. So you calculate the total value 54,95,500, sale price 8,500 per square means 26,400 2,647.46 per square feet. So the value sale price comes out to be 3 crore 7 lakh 10,536. You calculate cost of index cost 54 lakh 95,000 into these indexation factor 1 crore 99 lakh 46,850. So taxable gain is 3 lakh crore 7 lakh 10,536 minus 1 crore 99 lakh 46,850. This is the taxable gain. And at the rate of 20%, tax comes out to be 21 lakh 52,737. And if it is without indexation, then capital gain is sale price minus cost of acquisition. Sale price is 3 crore 7 lakh 36 minus 554 lakh 95,500. This is the taxable gain, and at the rate of 12.5%, it is 31 lakh 1,879. So then the condition will be, see here, with indexation it is 21 lakh 52,000. Without indexation it is 31 lakh 51,879. So here the condition will be checked. Which of these condition? If it is in this period, then you can apply any of the two methods. But if it falls in these, then you have to do accordingly. जी अभिषेक जी.
Sir, I purchased a property after 23rd July 2024. We can consider stamp duty value and legal charges.
Of course, if you have written it in your sale deed, if you have registered the sale deed according to the stamp duty charges, then of course you have to take that value. This is
Or
what it says.
without indexation, I will
Without
consider.
indexation, of course, it is if purchased on or after
See here, sir.
Even Mr.
And
Abhishek,
sold.
Mr. Abhishek, if you have paid any brokerage and it is mentioned on in the deed by you at the time of registration of the deed, then it will also be considered.
Okay,
This
okay.
is basically to reduce black money.
Okay, okay.
Because most of the time property is registered at guideline rate. And in that case, seller will be at loss because he'll have to pay 12.5% without indexation. And if he has actually mentioned the actual rate in the sale deed, then of course he will get benefit. So this is why it is done. This is just to reduce the black money in real estate.
Or in other words, we can say parallel economy, which was the essential subject in your examination. Parallel economy, which was a part of economics.
ठीक है
That is
संदीप जी, we can have a take break of 10 minutes.
Sir, if you allow, can we take for 15 minutes?
Okay, sir.
Yeah. So friends, let's take a short tea break for 15 minutes. It is 11:55 now. We will join sharp at 12:10. 12:10 पे दोबारा जुड़ेंगे. Till then, you can switch off your screens. But one more thing I need to